Hello, everyone. Good day. Today, our group will be presenting an in depth analysis of the US subprime financial crisis, which transpired between 2007 and 2010. This crisis was the most severe economic downturn since the Great Depression, and it originated in the subprime mortgage market and quickly spread to the broader financial system, which led to a global financial crisis and a severe economic recession. And we will be covering the key events, the causes, the regulatory responses, consequences, and the current state of affairs. So, for the summary of what happened, pretty much the US subprime financial crisis unfolded in several stages. It began with the housing market peak in 2006, followed by a decline in 2007. As housing prices fell, borrowers with adjustable rate mortgages couldn't refinance and they began to default. In February 2007, HSBC reported higher than expected losses in its US mortgage portfolio, marking the first major subprime related loss. Throughout 2007 and 2008, numerous mortgage lenders and financial institutions faced bankruptcy or required bailouts. Like, here's one example. The Lehman Brothers, a global financial services firm, filed for bankruptcy in 2008. The Dow Jones Industrial Average experienced significant declines, falling 8.3% by August 2007, and they continued to further drop in 2008. This crisis led to a severe global recession with millions losing jobs and many businesses going bankrupt. And I will also carry over the other part of the summary to Avhiyan.
So now summary of what happened. To provide more detail, let's look at the stage of crisis. First, the US housing market saw a peak in price around 2006. This was followed by a rapid decline in 2007, which caused a spike in mortgage default, especially among those with inadjustable rate subprime mortgages. The initial waves of default put immense pressure on financial institutions. In February 2007, HSBC reported substantial losses in its US mortgage portfolio, highlighting the scale of problem. By 2008, major in its major institutions like Bear Stearns and Lehman Brothers either collapsed or required government intervention. The Dow Jones Industrial Average fell by over 8% in just a few months, and the global economy slipped into recession. Unemployment rate soared, with the US seeing a peak unemployment rate of 11% in October 2009. Now let's move to the trigger and causes. The crisis has multiple interconnected causes. An extended housing bubble led to a significant expansion in US housing construction, home prices, and housing credit. Subprime lending became rampant, with loans extended to individuals with poor credit rating, often with adjustable interest rate. Banks then package these subprime mortgages into mortgage-backed security, also known as MBS, and collateralized debt obligation (CDO), which were sold to investors globally. Credit rating agencies underestimated the risks and gave high rating to these complex financial instruments, which allowed excessive risk taking by financial institutions, and the Federal Reserve's policy of keeping interest low fueled housing booming and encouraged risky borrowing.
Regulators involved and their effectiveness. The first regulator that we have is Federal Reserve, and they took no actions to prevent the spread of risky mortgage, and they were also criticized for maintaining low interest rates. And the second regulator that we have is Securities and Exchange Commission (SEC). They failed to fully anticipate the risk associated with the subprime mortgage, and they also failed to oversee the credit rating agencies. And the third regulator that we have is Office of the Comptroller of the Currency, OCC, and Office of Thrift Supervision, OTS, and they did not fully monitor the risk associated with the institutional activities. And the last regulator that we have is Federal Housing Finance Agency, FHFA. Questions were raised about the long-term viability and future structure of Fannie Mae and Freddie Mac in 2008 under FHFA's oversight, and consequences and victims of the crisis. The victims of the crisis were homeowners, and the foreclosure of the mortgage often resulted in homeowners being displaced from their houses, which led to housing instability, and sometimes the homeowners even became homeless. And the second institution that was affected was financial institution. Some financial institution faced insolvency or bankruptcy due to their exposure to excessive leverage, and investors freeze in credit markets and liquidity issues made it difficult for investors to sell assets or access funds. Workers, the rise in job losses led to increased unemployment rates as workers struggle to find new employment opportunities. Global economy, decreased consumer spending and investment in the US and other major economies led to a decline in global trade volumes. Um, Social trust, the crisis severely decreased trust in banks, mortgage lenders, and other financial institutions.
Now let's move towards the next slide, changes to rectify the situation. To address the crisis and prevent future occurrences, several measures were implemented. The Consumer Financial Protection Bureau (CFPB) was established to protect consumers in financial sector by ensuring transparency and accountability. Banks were required to increase the capital reserves to better withstand financial shocks. Government interventions, including the Troubled Asset Relief Program (TARP), helped stabilize the financial system by providing financial support to struggling institutions. Now, moving towards the next slide, current state of affairs and ethical considerations. Since the crisis, significant improvements have been made, but some concerns remain. The regulatory framework has been strengthened through the Dodd-Frank Act and other measures, improving oversight of the financial system. Banks are now more stable due to higher capital requirements and stress tests. The CFPB has implemented various measures to protect consumers in financial markets. However, there are ongoing concerns about recent regulatory rollbacks that may expose the system to new risks.
In conclusion to these events, the US subprime financial crisis was a significant event that had far-reaching impacts on the global economy. It highlighted the vulnerabilities in financial systems and the need for better regulatory oversight. This crisis was caused by a combination of factors and low interest rates. The consequences were severe, affecting homeowners, financial institutions, investors, workers, and the global economy itself. In response, regulatory changes were implemented to rectify the situation and prevent future crises. However, ongoing vigilance is necessary to maintain stability and prevent similar events. The crisis also emphasized the importance of ethical standards in finance to ensure trust and stability. This is the end for our presentation, and thank you so much for tuning in.